Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Former New York Fed President Bill Dudley writing in his latest Bloomberg opinion piece, the U.S. Federal Reserve and its chair, Jerome Powell, are rightly choosing not to act on any assumptions about what Donald Trump might do as president. That said, if he follows through on his more extreme campaign promises, they'll struggle to contain the economic consequences, a problem that equity investors ignore at their peril. Bill joins us now. Bill, you've been in the room. You understand what this is like. Give us a sense potentially of this tension that might brew between the Fed chair and President-elect Trump.
Well, in the short run, there's not going to be much tension because I think the Federal Reserve is still going to cut interest rates a bit further. But longer term, if you look at what the President-elect Trump is proposing, higher tariffs, deportations, and fiscal stimulus, that's going to tend to boost inflation, disrupt economic growth because tariffs will force people to reorient their supply chains. And it's going to make the economic environment more difficult. And so the Federal Reserve ultimately is going to react to that. But as Powell said in his press conference last week, we don't assume, we don't guess, we don't speculate. So they're not going to act until they actually see the Trump agenda actually take form. So don't expect any near-term response from the Fed. But in the longer term, I think if Trump does what he said he's going to do, it's going to be a difficult economic ride.
Well, Bill, as you point out, though, if Trump does anything big or abrupt, in your words, the central bank's response will occur too late to mitigate fully the economic impact. So what is the needle to thread to not respond too soon when we don't know the extent of things, but also not waiting too late that you just can't do anything at that moment?
Well, I do think there's a risk that if Trump isn't very aggressive in terms of his policy choices, that the Federal Reserve will be late. They'll be waiting to see what happens. And then when it does happen, it'll be bigger than expected, and it'll have bigger consequences for growth and inflation. At that point, I think the Federal Reserve would be a little bit behind the curve, and they might have to actually catch up. But that's not a near-term story. That's probably, late 2025, first half of 2026, just at the time that Powell's wrapping up his term as chair.
Good morning to you, Bill. In your opinion piece this morning, you talk about an oddly divergent reaction from the bond market and the equity market. I want to focus on the bond market because it has been a wild ride. And this morning we waking up, again, the birds have been reawakened. The question I would put to you is this. We don't know the tariff, we don't know the tax, we don't know anything about the fiscal policy exactly. We've some broad parameters. When you look at the term premium in the bond market, the debate is how much more term premium there needs to be if there's going to be such a large deficit run. Some of the numbers thrown out there are pretty obscure. But are we on the brink of where there needs to be a lot more term premium to hold U.S. Treasuries?
Well, I think that there needs to be some more term premium to reflect the uncertainty about the economic outlook and the unsustainable fiscal path of the United States. That's one area where Powell actually did speak out last week. He did say that the fiscal path of the United States is unsustainable. And if President-elect Trump does all of the things he wants to do in terms of corporate tax reduction, extending the 2017 tax cuts, the fiscal situation is going to worsen, not improve going forward. So I think the path to higher bond yields is the most likely path. The other thing that's happened, of course, is people have changed their expectations of where the Fed's going in terms of short-term interest rates. A couple months ago, people were expecting the federal funds rate to bottom below 3%. Now the markets are expecting the federal funds rate to bottom at around 3.75%. So if you have a higher federal funds rate, then you're going to have a higher bond yield just by construction.
So the direction of travel, you say, is higher in yields. When you look at the response from Powell at that news conference, and we've touched on this with various people, are we going to hear much more, I don't know what the right word is, aggressive, demonstrative, exacting language from the Fed? What word would you choose that the Fed's rhetoric needs to become more emboldened in 2025?
I think the Fed is actually going to be very, mild in terms of their language. They're going to set monetary policy based on what they think is appropriate given the growth and inflation outlook. And as you noted, it's going to take time for that to manifest itself because we don't really know exactly what President-elect Trump is going to do. So I think the language will be actually not combative at all. You saw last week, reporters asked Powell about, how he can react to the Trump policy mix, and Powell basically said no comment. So I think in the very short term, the Fed's going to keep its head down and conduct policy based on how the economy is doing right now.
But if we can take a step back to the reaction that we've seen here and the now, as you write in your column, you find the stock market response baffling. Equity bulls have been really excited about the prospects of tax cuts and deregulation. What are they missing?
Well, I think that the stock market has this notion that we're going to have deregulation, we're going to have corporate tax cuts, and that's going to boost corporate profit margins. And I think that's probably a fair part of the argument. But I think what they're missing is all the consequences of the other parts of the Trump agenda. Higher tariffs mean higher inflation. They mean disruption, lower productivity growth. Deportations affect the supply of labor. And unsustainable fiscal path means higher interest rates. When I look at the bond market versus the stock market, I think the bond market, as bond yields rise, that's going to put increasing pressure on the stock market. We're starting from a point that the stock market valuations are already extremely high. So if bond yields go up, I think that will weigh on the stock market. I would not be a big stock market bull at this point.
Bill, given that backdrop, how difficult is this December meeting going to be for the Fed?
I don't think it's going to be that difficult because I think Powell laid it out pretty clearly last week. They think that the economy is, the risks of inflation and the labor market are roughly in balance. They think monetary policy is still restrictive, so that they're heading back towards neutral slowly. So I think a 25 basis point rate cut in December is still the most likely case. Now, if the economy continues to stay stronger than expected and inflation stays stickier than expected, then that December rate cut might be the last rate cut for a while, but that really depends on the data. The Fed right now is really data dependent in terms of where they're going. The direction of rates is downward, but slowly because the economy is continuing to perform pretty well on the growth side.
Last week, Powell was asked a number of times by journalists about what would happen if President-elect Donald Trump tried to remove him. And this morning in the Wall Street Journal, they talked about 2018. And Powell then went what they're reporting to Treasury Secretary Steven Mnuchin and said that he would fight his removal if sought by the president. Are you concerned about the independence of this Fed?
Well, I think you have to always be concerned about the independence of the Fed when you have a president that seems to be, president-elect that seems to be hostile to the Fed's independence. And, the reason why we want an independent central bank is because historically, independent central banks actually do a better job in terms of managing monetary policy to achieve the outcomes that we want in terms of growth and inflation. So independence is really driven by the fact that you actually get better outcomes. If people think that the Federal Reserve is going to change course based on pressure from the president, that increases uncertainty and risk. And it also makes the Fed very short-sighted in terms of its policy agenda. So I think the Fed, basically the Fed's going to try to maintain its independence. Powell, I think, was very, very clear last week when asked about whether he's planning to resign early. No. Whether Trump has the right to fire him legally. No. So Powell basically said pretty clearly, I'm going to finish out my term, which ends in May 2026. And so tried to close off the debate on that whole issue.
Not permitted under the law. He kept saying that, no, no, no. And the Wall Street Journal gives some insight into he knows this because he went through it in 2018. Former New York Fed President Bill Dudley, thank you so much for your time and insight this morning. All right, let's turn back to U.S. politics. Donald Trump's next cabinet beginning to take shape. Trump picking former New York Congressman Lee Zeldin to lead the Environmental Protection Agency. Trump saying Zeldin will, quote, ensure fair and swift deregulatory decisions. They'll be enacted in a way to unleash the power of American businesses. Joining us now is Tom Steyer, former Democratic presidential candidate, of course, and the co-founder of Galvanize Climate Solutions. Thank you so much for joining us around the table. So we're going to get a Trump 2.0. Potentially they're going to roll back a lot of the work the Biden administration did when it comes to the energy transition. How much does it matter? Because the market is already off to the races.
Well, let's talk for a second about what's really driving the energy transition, which is economics, prices, and markets. Over the last 4 years, solar prices have gone down by 60%. Solar sales have gone up 4x. If you look at what's happened to batteries, last year, just in 1 year, they halved in China. The price halved. If you look at what's going on in terms of EV sales, we look at it in the United States, still going up, but not going up that fast. If you look at what's going on in China, they went up 11% month over month. They went up 50% year over year. When you look around the world, what's going on is abundant renewable energy. That is actually the story. What we're seeing in the world is a huge move to renewable energy and the energy transition happening much faster than people in the United States understand, while we're talking about oil and gas, which is basically a stagnant market.
So what does that mean to have a drill, baby, drill policy at a time where you already have peak oil domestic production in the U.S. and you have this transformation you're talking about? So
let's put some numbers on it so that we can really understand what we're talking about. The U.S. is the biggest oil and gas producer in the world. We do about 13.5 million barrels a day. If we do drill, baby, drill, we could take 13.5 and move it to 14. In the context of the world oil market, we're doing about 102 million barrels a day. That is not, this is a stagnant market. Even OPEC thinks that the total amount of oil sales will go up by 8% in the next 25 years. Solar sales went up 4x in the last 4 years. So what we're really seeing is an exploding clean energy market. We're not running out of oil and gas, but what we're seeing is an abundance of renewable energy and an abundance of new technologies that are competing on price. You know, I wrote a book, Cheaper, Faster, Better, How We Win the Climate War. And really, that's all we're seeing is market forces, business. How do you win? Cheaper, it's cheaper. Faster, it's faster and better. And so when we look around the world, governments can't repeal markets. China can't repeal markets. Neither can Donald Trump. What we're seeing is people around the world acting based on prices, what's in their own interest, and what's the best product.
There is another large source of energy demand that's really ramping up quickly besides the renewables, or it goes in tandem with the renewables, and that's the energy needed to power AI. Basically, the amount equivalent to large cities needed to power even just Meta's AI demand. When you look at that and you look at the Trump White House push or the coming White House for deregulation, is there red tape that needs to be cut anyway to allow for this huge source of energy that's going to be needed to power the future?
Of course there is. I mean, when you look at the United States, we are very, very slow in terms of permitting. We're very, very slow in terms of adding new clean energy products or oil and gas projects to the grid. So yes, we have a very slow-moving process because so many people are allowed to weigh in. It just takes so much time. And of course, we should be moving much faster. But when we really look globally about where we're talking AI can move U.S. energy consumption by 20% over the next decade. That's a huge move for us. But if you look around the world, if you see what's happening in Asia, Southeast Asia and South Asia, like in India, it is growing exponentially. They're going to do 5 times as much electricity by 2050, 5 times as much. And so when we really think about what's going on in terms of what's driving prices, what's driving volumes around the world, where the real business is, what we're seeing is it's really in renewables.
And it's interesting, just as we touch on that oil subject, OPEC has released their report. Oil consumption is down 18% since July. This is the 4th consecutive cut that they have in terms of demand, and that's to do with China. I want to focus on one of the things that irks Donald Trump, we know, is other people eating America's lunch. And any move that he makes to step back on IRA, which is done very well in the red states, by the way.
Overwhelmingly in the red states.
Overwhelmingly in the red states. So just how aggressive a pullback is there going to be? Because I can tell you what, there's a lot of European and global CEOs sitting out there who are going, I'm ready to eat your lunch. If you don't want to build this business, we're ready to do it.
Look, that is the point I'm trying to make, which is America has to compete. America, this transition is happening. America should be leading it. This is an absolute necessity for us to be the leading economic country in the world, the leading political country in the world. And I think it's going to be clear, no matter how Mr. Trump feels about what should happen, what is happening is this transition. And American companies can absolutely dominate here. But we have to choose to do it, and we have to put the money into it, and we have to put the manpower into it. So I look at this as a great chance for business, and it's just business. This is just about what is cheaper, faster, and better, and that is traditionally what Americans have done really well at.
Well, then what level of stimulus could we see from him? What level of incentive could we see for these areas? He's been very heavy on the rhetoric against a lot of the incentives that were in the IRA, etc. So how does he temper that? How does he balance this?
I really think that what's going to drive this is American business. That it's not. Of course, the incentives of the IRA were important in terms of deployment of solar, of wind, and the sale of EVs. But the truth is, all of those things are going to keep happening globally. All of those things are going to keep happening in the United States. I mean, if you think about the idea of solar prices going down by 60%, if that would be oil going to $32, from $80 to $32. That didn't happen. But you know something? It's not stopping down 60. We'll go down another 60%, and it'll be at the equivalent of $15 per barrel of oil. That's dominance.
If the private sector is doing this already, though, and there was concerns that spending too much at a time when inflation at one point during the Biden presidency hit more than 9%, then what was the point of something like the Inflation Reduction Act? The former president, future president, continues to talk about that he's happy with clean energy. He has someone like Elon Musk surrounding him, but he thinks it should be driven by the private sector.
It is going to be driven by the private sector. It is driven by the private sector. I think when I think about the Inflation Reduction Act, I think about an attempt to try to subsidize companies that are clean to try and put them on a level playing field with companies that are polluting. That's really how I think about it. But over time, when these prices come down, the need for subsidies goes away. And that's really let me give you one example. Over the last 3 years, Texas has tripled the amount of solar it uses. Texas. They are by far the biggest wind producer in the United States. The 4 biggest wind producers in the United States are all deep red states. They're not doing it because they love the concept of renewables. They're doing it because it's cheaper, because it's good business. And that's what we're seeing is, in fact, cheaper, faster, better. Markets, prices, economics. That's what's driving this world. People are talking, people are saying things, but really what's going on behind the scenes is just, you guys were talking about the dollar. What's driving the dollar? What's driving interest rates? Prices and markets. You can't revoke them. Right. We're in a world where, in fact, we are going a very straightforward way, and we can talk about it, and the sentiment can move back and forth. But if you look at the first Trump administration, actually clean energy did really well.
It did.
Yes. There was a lot of rhetoric, there was a lot of anger, there was a lot of emotion, but the fact of the matter is the world just kept powering right through it.
Tom, we thank you for your time this morning.
It's great to see you.
Tom Steyer of Galvanize Climate Solutions. Bank of America's new consumer checkpoint. The consumer shows solid momentum as we head into the holidays. The 2024 Bank of America Holiday Survey suggests people are planning to spend $2,100 outside of typical obligations and necessities this holiday season. That's up 7% year over year. Joining us now, David Tinsley of Bank of America Institute. David, thanks so much for joining us. Read through your report. So let me just get this straight. Are you seeing any signs at all of a consumer that is slowing down?
Yeah, I would tend to take issue with the interview you were just showing there, saying that the consumer looks stretched and is potentially slowing. I mean, in our data, what we're seeing is that our credit and debit card data was up 1% year on year in October, and that's a pretty good number for this data series. And then, of course, if you overlay that with the, I think, 4 months in a row rise in consumer sentiment in the Michigan survey, and then when you look in our data again at what's going on in terms of wages going into people's bank accounts, the year-on-year growth there, I think, is around 2% or so across all income cohorts. So it's not obvious, I don't think, to us that the consumer is slowing. I think we would characterize the situation as continued forward momentum.
David, Anne-Marie and I have been talking about all morning, different companies saying, look, consumers are putting off big ticket purchases until they know the outcome of this American election. Did you see the same pattern in some of the spending, that there's going to be some form of financial firepower unleashed now with the election behind us?
That's an interesting question. So in last month's checkpoint, we did note that we saw some consumer durable purchases, so big ticket items, some slowdown there. So it could be that there is some pent-up consumer demand in those sorts of areas. But overall, the position is not a bad one in any case. I mean, what we do see in our data, and I think this speaks to the kind of differential corporate experience, is that the consumer continues to be valuing experiences over goods. So in other words, it's meals out, lodging, airfares, those kind of things are the items of particular strength, more so than on the goods side. So I think that explains some of the differential corporate kind of news flow on this.
David Tinsley, we thank you so much for your time. David Tinsley of Bank of America Institute on the health of the consumer.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.